Good afternoon, traders. This is Christian Farmer at Strawberry Trade Group, and this is your end of day market recap for Friday, the 20, what is today? The 21st of March. And happy quadruple witching to those who celebrate. Sorry, that's a horrible joke, but yes, today, a lot of volume on the open, some selling into the open today. Some of those big imbalances that were offsetting. That's always baskets of stocks always offsetting futures expiration for what people are still holding on to in terms of March futures. Most of that done on institutional trading desks. So big volume on the open, a little bit of selling, and then the opposite on the close today. So a ramp into the close today for quadruple witching. I still call it, I know it's officially like, I think they call it triple witching now because they drop off one of the witches due to really people don't trade stock futures anymore. I guess that used to be a product a while ago, but I do still call it quadruple witching because of the index rebalancing. So nobody, for whatever reason, people don't associate that. I think it's hard to explain. That's why people don't necessarily understand it. But basically, it's all the S&P, and I believe NASDAQ too had index rebalancing too, where they set their indices back to benchmark weights. I'll try to explain that in like 15 seconds or maybe 30 seconds. But basically, what happens is like, so for example, if you look at the easiest way I can explain that is when you look at the equally weighted indices, like so for example, if you look at XRT, which is an equally weighted index, if you notice the weights here in this column here, right now, Albertsons and Walgreen Boots, BJ Wholesalers, they're the top weights. They're the top weights in this ETF. Why? Even though it's an equally weighted ETF and everything should be the same weight, the reason why they have a bigger weight, I mean, not that large, 1.89 versus the lowest weightings there, which are about 0.35 or 0.1%, like Shoe Carnival is at 1%. Because the variable from the last rebalancing time, and again, these are quarterly rebalances that happen. So that was December, it's March. What is the one variable that's changed from December to March? Well, that's price. And things like BJ Wholesaler, Walgreens, Ace, Albertsons, what else is in here? AutoZone. These are the ones that have outperformed. So their prices have gone higher. And that means they're a larger by default because there's no other variables there. They become a larger weight in the index. And Shoe Carnival, which just had earnings the other day, had bad earnings. That's one of the lower weights because price went down. So how the indices work and the mechanical nature of them is what'll happen is if there's more long assets tracking this ETF, and I don't know if there are right now, I'm not going to go into the weeds with that, but basically what they'll have to do is sell down the names that have grown because of their price going up, and they'll have to buy the underperformers. So, and if there's more short assets tracking XRT, which sometimes there are, it's the opposite. So this has to happen for, and I use an equally weighted index, such as XRT, and it's the same thing for XHB or XBI or any of those XSD for those indices, for any of those equally weighted indices. But it's also the same for the market cap weighted indices too. There's just usually less rebalancing that happens for a market cap weighted index, but that's what creates all the volume on the close, as well as, of course, what retail traders seem to get planted in their head about how important option expiration is for the month. So it is important. Options expiration can move things, but I think actually the larger volume on these quadruple witching occurs because of the index rebalancing. So always important to have all those things in your mind a little bit and all the components, right? I know that there's some folks that tend to focus a lot on options, some focus a lot on stocks, but you have to look at all these components, and that can really cause the volatility for the day. So regardless of all that stuff, it took me a little bit longer than a half a minute to explain that, but I do my best with some of the more complicated subjects, and I try to really kind of give you a flavor for what drives some of the volume. So, the main thing is if you're looking at charts over the weekend, don't get distracted by, oh my God, there was so much volume in that name, right? It's the same thing. We were talking about this earlier in my trading room. Like, don't get distracted by folks will say, oh my God, there was big inflows into equities this week. That's all because of quadruple witching. And literally that happens every quadruple witching. There will be big inflows into equities, and it's all ETFs, and it's all because of the rebalancing. So write down this, you can, this is really minor, but it's just don't get distracted by those who are putting out about all the inflows. Write down the third week of June, the third week of September, the third week of December as well, and put that in your calendar, because you'll get the same exact information from these people who will talk about huge inflows that happen. It's a very mechanical type thing, and it's basically noise. And same thing when you go and you look at your charts over the weekend, do your chart studies as many folks do. Don't get caught up in all the volume that occurred in each stock to think, oh my God, there was huge buying in that name on Friday. It's all because of the index rebalances. All right. So that's noise. I'm sorry to kind of go through that, but I don't know. I feel like sometimes I feel like talking about things that others, where you see a lot of misconceptions that float around about, oh, all the inflows that happen this week. It happens every third Friday of every third month. Risk disclaimer in front of you. Everything that we're going through is for information purposes only, not giving any advice or recommendations. Please read the full risk disclaimer there. And this was a tough week. I think it was a very range bound type week. So I would rather talk about some of these things that make sense to me than the price action this week, because this week, if you look, we basically finished the week right where we started. And if you even go back, so this is what I'm referring to, is this block right here. This was the value area for the week. It's nice that we ended up staying above the value area for the week. Here's basically where we started. One thing that I kind of honed in on as the week went on is that we couldn't break through the week's highs. Here's where we were on Monday. And with that strong, remember, we had very strong breath on Friday and Monday. And then the rest of the week was really kind of like topsy-turvy, I would say. We had a couple of days where the breath wasn't good. We had a couple of days thereafter, I think, where the breath was okay. It's tough to make any conclusions based on today because of just all those mechanical flows that are hitting the market. But we know that earlier in the week, we tested trying to break higher, and the market just wasn't ready to do it. Now, you could say the same thing about the downside, because here was the low for the week, right? Which is right around like this test here in the beginning of Monday. We held this on Tuesday, and then we began to move higher. And we held it this morning too. So we didn't break. So it's really tough to make a conclusion. I know there's perma bulls out there, there's perma bears, but I don't know how you could really, I think if you stay in the lines and try to just understand what the price action is telling you, is that we've got a lot of indecision right now going in the markets. Because even if you go back a week, and this was last week's price action, notice essentially where we closed is very close to where we started 2 weeks ago. So if you took a vacation over the last 2 weeks, congratulations, because you didn't really miss anything. Now, of course, you could have played each side, and depending how good of a scalper you were and how aggressively you bought the lows, probably defined your week, as well as how aggressively you sold the rips this week. That's where you could have made money. But really, I think it's a very challenging environment because there is no follow through. Like if you were thinking, hey, we're going to turn the corner this week, you were probably somewhat disappointed. And if you added into where you thought the market was turning, you probably got caught a little bit. And that's not easy. Some, including myself, I like to see a little bit of confirmation that the tape looks strong. But those days where the tape looks strong, the next day it gave you a completely different picture. But like I said, we didn't break. So I find it interesting too. When we look at the weekly chart, now that the week is done, we can do that because we've got the full information of the close. And SPY just barely closed above the value area for the year. So we are hanging on to that uptrend in SPY basically by a thread at this point. That level again is 561.37. Again, I'm not going to make a whole bunch of decisions if we close next week and it's barely below, there's a little bit of room for error here, but it is interesting that we're holding that. The Qs, on the other hand, and the Qs were strong. The Qs came back quite nicely today. Here is the price action today for the Qs, and you can see you got a nice green bar. We also are trying to stay above this 5-period moving average, but again, similar to the S&P, we're really not doing anything other than exploring, different different areas around a range. So again, I don't think that you could be very I don't think you want to be too negative here, and I don't think you want to be too positive here. We know that we've had a dip, but we don't know if the lows are in. At least I don't. I know some people are claiming that they think that the lows are in for the year. God bless them for their crystal balls to understand that. We did obviously, going back to last week, we did see fear finally creep in, but I'm not really seeing any conviction either. I do think when the market rallies a little bit, it's retail doing more buying than anything. I don't think the institutions are jumping back into this market. Maybe they're nibbling a little bit into some positions, but I think that there's still a lot of uncertainty out there, and that's what's causing folks to kind of do a little bit of wait and see. Um, so looking at the weekly chart here in the Qs, I even though today the Qs were strong, I still think, until this gets back above the top of the value area for the year, 480, 486.56, the Qs are showing a little bit of relative weakness. And I also try to kind of think about this a little bit intuitively too. What is going, let's say that we get some type of action from the Fed where they decide to cut interest rates, or Trump decides not to go ahead with tariffs, and they are being used as a negotiation tool, which some agree with, some don't. What he's doing with the tariffs, and let's say that he pumps the brakes on the tariffs. Who do you think, it'll be very interesting to see what the new leadership is going to be in the market now that we've seen basically everything come down. We know that we have seen some things like the insurers show some strength, some low volatility, healthcare companies do well. Some of the energy companies have been doing well. Tech really, you have to selectively look through tech to find some names that are doing okay and holding up. But I think it's going to be very interesting if we do rebound, what's going to be the new leadership. I'll come back to that question because I don't really think that we're seeing that many hints right now. Here's the weekly chart of IWM. Again, it's kind of paused with the move down. I mentioned that it had a little bit of a fight here with the 20-day moving average, and it was above the 5-period moving average. Well, that lost the battle, and price is below the 5-period moving average at this point. So I wouldn't be surprised if this starts to head back low and test those lows. After all, the bearish 80% rule is still in effect for the year, and that means that maybe by the end of the year, again, we're only in March, but maybe we could see a move down here. But regardless, this is still a tough looking chart. I also, wanted to look at the Dow on the weekly chart too. This is holding up a little bit better. Notice it's a little bit farther away from the value area, and it's also above the 200-day moving average. And right now, I kind of think that the market likes the Dow stocks, right? What are some of the things, some of the commonalities about the names that are in the Dow? Well, their dividend, I believe, I don't know all the criteria, sorry, on the top of my head for it to be in the Dow, but I think there's usually, higher, there's names that have like a steady stream of income. They, in terms of their earnings, like their earnings are a little bit less variable than say, high growth names. Most of them issue dividends, if not all of them issue dividends. So I think the market is more comfortable with those types of names for now. And I think that's why you see the Dow outperforming a little bit on the charts, and has a little bit more room above the value area. Now you look at this weekly chart, and it's not to say that I'm in love with this chart either, because this does look like, lower high here. And maybe this goes in a channel for now. So I think that's going to be interesting. I'll also review this week's performance with you. The S&P did squeak out a gain. I had to fix the data because SPY went ex-div this week, which it always does in quadruple witching, but the week of quadruple witching. But SPY did finish up 0.5%. Dow was up 1.2%. A lot of green, but not that great performance. Qs finished up 1/3%. EEM was flat for the week. EFA was just down slightly. Interesting. I want to review the TLT chart because I thought that that candle yesterday was very interesting. Here's what TLT looks like. You still have the bullish 80% rule in effect, and that would complete with about another 3% move higher. Looking at a couple of these candles from yesterday and today, you know, notice what's happening here. You know, they're put in a lower high here. So, you know, I started to think for a bit that bonds were going to be the trade. You know, IEF is holding the shorter maturities are holding up a little bit better than the longer maturities. Here's IEF, which is 7 to 10 year bonds, still holding in there, you know, and holding above these moving averages. Here's SHY, and I am adjusting for dividends here. Like if you bring this chart, I've had people question that, and they're like, "Hey, my SHY chart looks different than yours." It's because I'm adjusting for dividends. This pays out dividends quite frequently. This is the short end of the curve, 1 to 3 year bonds, moving higher, but not with any major strength. I'm going to come back to that in a minute because I think that that's interesting. Sectors, I'm just going to go through a couple that I think are interesting. You know, I've talked a lot about energy. Energy still has to get through some resistance. So energy had a nice week. Look at your performance. XOP was up 3.5%. XLE was up 3%. So those were your leaders. However, you got to get through resistance, and this is still very, very sideways. And again, you know, I'm looking at things and just understanding what they're telling me. It's a nice rally up into resistance, but we failed here a couple times this year. Beginning of the year, January, where energy was doing really well, and then completely stalled out. Also here and here, so I think you have to be selective in a lot of these sectors. Also, I thought what was interesting was the financials did well this week. Let me go back to this chart. Where are the financials? They were up 1.9%, so outperforming along with the gold miners. Retail was really interesting too. Retail was up 2.2%. That shocked me because you know, I've really been believing that the consumer stocks have been weaker, but you had an up 2.2% for retail. Let's talk about the financials. So XLF. And so again, this is another area where it's a little bit of a you got a decision coming here because we're into the 20-day moving average, weren't able to get through it, but holding the 5-period moving average. Now we know what happened to IWM. IWM lost the battle for now, below these moving averages, but financials are they're hanging in there. Here's JP Morgan has made a real nice move off of the 200-day moving average, but we'll have to contend with some overhead resistance. All right, here's WFC, Wells Fargo, also has a decision in here, 20-day, 5-day moving average, right? And another number of other stocks too. I want to just go through a couple other things that I found interesting. Tesla had a big day today. Look at the weekly candle for Tesla. It's the second hammer bar. Now, as I mentioned last week, and I brought up Tesla a couple times, I will be paying attention if it breaks 257.71. I don't care that I'll be a little bit late versus being, you know, you have the chance to be wrong and early or correct late and correct and be a little bit late. I don't really care about 3.6%. That could be a day's move. I would be looking to see if this can get above this and really turn the corner. For now, it has stopped going down and it's been some resilient. Buyers are coming in here. All right, but we have not turned the corner yet. The battle is not won yet by the buyers. I find that interesting. Spotify was a name that I looked at several times this week. Not a bad weekly bar, but look at where it is. You know, it's having this difficulty with the bottom of the value area. So what I really look for is if some of these stocks, even the ones that behaved a little bit better, were able to kind of conquer some short-term resistance. And I don't see that in a lot of stocks yet. So I'm trying to be as objective as possible. I like that that a couple of these things outperformed. They just didn't take back any technical levels, right? You're pushing right into the bottom of a range. And for it to, you know, for this market to be a little bit more meaningful, I've got to see some levels to be regained. That's a couple sectors. Here's also what all the sectors look like. Now, this improved drastically. I had many on this list. because of this last hour of the day, which was or last 30 minutes of the day, which was strong. Many of these were all flashing weak, right? So you only have a couple of these things. Now you don't really have much strength other than XLE, which I just covered, but you don't have a lot of things. Like looking internally at the sectors is showing more weakness than strength. So even though we've been going sideways, I look for hints in the internals and what's going on in individual names. There's some bright spots, but there's an awful things that still look pretty darn weak. So this market has a lot of work to do. Let's talk really quickly about the Fed meeting that we had on Wednesday. I don't know where people thought the Fed meeting was dovish. I didn't really hear anything really that drastically dovish. If you think I missed something, let me know. I know that they're going to be reducing the tapering a little bit in the balance sheet, but and I don't think that they were really hawkish either. I think they're just neutral and they're waiting for more information. I don't blame them. I think that a lot of times the Fed is late, and they probably will be late again when they have to cut interest rates. But I understand that they want to see inflation come down more, and the data points that they're looking at just are not there. Now, what I find very interesting about this, right? So the white line is the Fed funds rate, and the yellow line is the 2-year yield. Notice how well what happens here, right? We probably think the Fed looks at all these different factors, but really the Fed fund rate moves very consistently with what the 2-year yield is. Remember, I showed you that chart of SHY earlier, how it's been moving up. So if this begins to break down, this yellow line, which is the 2-year yield, which is the opposite as basically the chart of SHY, because that's looking at bond prices. The yellow line is looking at yields, which is an inverse relationship. If this begins to break down, right, then I think you're going to have your answer about whether the Fed is going to be cutting interest rates and probably doing it maybe, in the next coming months. That should give you a sense. Why is that important? Why do I bring that up? Because at this point, I think for like a really sustained move, you're either going to need Trump to backpedal very heavily on his tariffs, or the Fed needs to start cutting interest rates because 4.5% is at a tightening rate. Is at a high level. And you could see how many times over the years, this is going back all the way to the 70s, how many times has this rate stayed high and stayed high for long? It usually doesn't stay high for long because why? Because when you are tightening and you are causing you are really tightening on the consumer with this type of interest rate. And again, I don't want I'm sorry to go off the beaten path, but it's good to think about because I don't think people have really thought about this in a while because again, we have had so much prior to Trump, and I'm not trying to be political here. I'm just trying to tell you how it is. We've had a huge amount of fiscal stimulus over the last 4 years, whether people realize it or not. But you could look at the debt levels, right? They were pumping in money any which way they possibly could over the last 4 years, and that that was undermining what the Fed was doing. Now, and again, the reason why I'm bringing this up is so that you understand there is no more of that fiscal stimulus. So now you go back to what the level of the interest rates are, 4.5%, and it's cost more to get a mortgage. It costs more to get car loans, right? Now I know some of those things are on the long end of the curve, but they have implications too with the short end of the curve, which is what we're looking at here too. So this is still a very much a tightening environment. The Fed begins to bring down that rate, it will do it will help the economy and it will help the stock market. I just want to bring up what the expectations are because again, the reason why I'm bringing this up now because it's more important than it was 6 months ago because the fiscal side was Janet Yellen was pumping money and pumping liquidity into the market. So it mattered less what the Fed was doing. You don't have that now. So now this becomes much more important. There's a 20% chance, 21% chance that they're going to cut interest rates in June. That's June 18th. July, whoops. Sorry, I'm on the wrong thing here. May, it's the end of the week. May 7th is the next Fed meeting. 21% chance that they're going to cut. right? This is the probability. June, notice what's happening here. The market is starting to price in an interest rate cut in June for the June 18th. However, that's 3 months away. So we'll have to keep an eye on some of these things. And that should shed light on if this environment is going to be easier or more difficult, right? We start to get a more dovish Fed. This market's going to like that. Until then, or until something changes, I think the price action may not be as exactly as it was this week, but still might be a challenging environment. That's it for this weekend, and of course, I'll update. I'll have a weekend video out for members where we go more into detail into sectors as well as single stocks. Have a great weekend, everybody. See you on Monday.